Well, value investing refers to a style of fund management which advocates investing in those assets which are underpriced and by default have fallen out of favor with investors. Can adherents of value fund management teach anything when it comes to the preservation of capital? Now, keep in mind, Linda has in fact written a paper called Nothing Quite as Beautiful as Cash. You can find that on our blog, and that's what we're referring to today. The topic really not so much focusing on cash, but on the value of fund management and value of value investing rather, and by default often you move into a cash position during bear markets. So Linda, firstly let's start off with you. Very broadly, if you could just kind of take us through the key themes that you're looking at from the paper perspective, and then of course we'll go dissect each of those issues.
Yes, absolutely. Well, the topic of the paper really came about because a lot of our funds are holding quite big positions in cash at the moment. And after the financial crisis, there was a lot of debate about tail risk strategies and whether they were a crucial component of a portfolio. And our argument is actually that cash is the best tail risk strategy for any investor. It's easier, it's more sensible, it's often safer, and it's a lot more straightforward than very complex derivative strategies.
Okay, so that's pretty much what the paper is proposing. Kobie, let's get your views on this. There are some theories, behavioral finance theories, that suggest that people are a lot more worried about unexpected losses than they are pleased about unexpected gains. That's just been proven. It's human nature. But what context does that have for investing?
Well, listen, I'd like to start off with a quote that Linda actually has in the paper. It's by Monty Python, and it says, "There's nothing quite as wonderful as money. There's nothing quite as beautiful as cash. Some people say it's folly, but I'd rather have the lolly. With money, you can make a splash." And I think that's so true for fund management. You know, if you've got cash in times of turbulence, it certainly helps you to be able to have the dry powder, so to speak, in order to spend into a market that potentially becomes cheaper. And I think this is the point that Linda's trying to make in this paper. As a matter of fact, just have a look at the graph that's on your screen at the moment, and what you'll see is actually an extract out of the actual paper. Linda assumes that a market continues to increase by about 5% per annum. There you can see the 5% per annum increase in capital value up to year 11. If you lose though, and you've got an unexpected loss in your first year, and thereafter you continue to have a gain, but you continue to do better than the market, then your total return is 10% per annum, hence you're doing double what the market actually does. You're going to battle to catch up. And this is the beauty of cash. It's the ability to be able to kind of safeguard capital in times of turbulence. But then it begs the question, how do you know there's going to be times of turbulence? And maybe that's a question that we should be asking. So
before we get into that, Roland, who knew, of course, that Monty Python had some advice for us when it comes to investing. But let's talk about losses and the impact that losses can have on long-term returns.
Yeah, I think it would be useful to put this into context as to what the cycle is of a market, because when we're talking about a crash, that is only part of your long-term kind of exposure to the market. It's certainly not the kind of thing that you're going to be in for forever, but at the moment we're seeing a bear market, which is slightly different to a crash. A crash is when the market tanks, and a bear market is sort of the drawdown or the time it takes to get out of that kind of trough. So before a crash, we tend to have a momentum market, and value investing tends to underperform in those kind of markets, and then you have a crash. Now in a crash, the best thing to have is something as beautiful as cash, but you don't want to have cash for too long, because having cash in the long run just reduces your ability to grow your returns. So we have to understand that during a bear market, I think personally from my research, it's better to have a value exposure in a bear market than cash. In other words, you have equity exposure, but you're getting you're getting an outperformance with value investing, the value risk premium, that adds to your performance. So cash doesn't give you any excess return, but it prevents you from losing money. So cash is a very temporary kind of thing that only adds value in specific situations. And in a bear market, you want to have value, and in a not in a bear market, you want to be in something like momentum or growth or something more geared to the market.
Yeah, I mean, Linda, when we're talking about bear markets and of course then, finally moving into a bull market, what about timing? I mean, how do you know when you are in a bear market and, when it is the right time to start moving more money into cash, basically?
Well, Roland makes a very good point, which is that it's better to be invested in undervalued equities than it is to be invested in cash, and we would totally agree with that. The problem is when you're in a momentum-fueled market and everything's going from expensive to even more expensive, in other words, trading way above what it's actually worth, there are fewer and fewer of those absolute value opportunities in the market. So there are few things that are trading substantially below what they're worth. And as a result, we defer to cash. So we're constantly looking for those opportunities. But what tends to happen as market risk increases and the market gets more and more expensive is that we start to build this cash position out of default, in the sense that we can't find enough value opportunities. But the great thing about that is that you don't have to think about market timing. What you're doing is, as equities go above their fair value, that forces you to sell out of those equities, and you start building this cash position. And what's happening is you're actually taking money off the table as market risk is increasing. When the market falls, and that's when you know you're in a bear market, when there's a substantial fall in the market, then you have that cash, because all of a sudden those equities that you want to own are trading at substantially less than what they're worth, and you've got the cash to deploy into the market at precisely the right time.
Do you agree with this, type of investing?
Yeah, I mean, look, we're talking about a style of investing, which is kind of, if you had to run a business, this is the way that you need to be thinking about how you need to deploy capital. So hence, you're sitting at a point in the market where things might be cheap, and hence you're deploying your capital because you believe that the long-term value or the long-term ability to be able to gain a return from a market is swayed in your favor. And as the probability turns against you, you start holding larger and larger portions of cash. The problem that we've got is not so much the actual theory around this. The problem is the investor. Because I want investors to be able to believe this and to continue to invest long term as far as this stuff is concerned. Because the investor fails at the end of the day. The investor, once a fund starts holding cash, and there's a whole bunch of funds out there with a lot of momentum strategies, and they start doing way better than what a value sell does with some cash attached to it, then you start seeing investors saying, well, actually, I don't want to do this anymore. I want to do something else. And that's probably the worst thing that you can do for returns, because you're chasing performance at the end of the day. That becomes quite difficult. And I suppose, Linda, one of the big things that you guys must be thinking a lot about is how do you differentiate between a black swan event, which is kind of those once-off jolts to the market, which kind of just shakes the market and you don't know when those are going to happen, versus a predictable downturn, something which happens and you can actually see it happening.
Well, Kobe, most market collapses are, we feel, not black swan events. As you say, that's entirely unpredictable. Before a market collapse, often there are commentators who are warning market participants that risk is increasing in the market. There are those in the market who are foreseeing some kind of market decline. So we would say that most market declines are actually just predictable market cycles, where markets go well above fair value, driven by momentum, as you say, people chasing short-term performance, and that only lasts so long. So we would say that really you can't plan for black swan events, but the good news is that most market declines are actually quite predictable. The timing is not predictable, but the eventuality is predictable.
Linda, can I ask you a question? There's obviously, when we're talking about cash management, what I like about fund managers that are sort of bold enough to hold cash, I see that as a fund manager who cares about risk. Most fund managers don't care about risk, they care more about return. So they're very reluctant to manage downside risk because it hurts their ability to outperform. Now, what I'm trying to get to here is, where does market timing, because to me, I want to see some kind of risk management from a fund manager, but that, to me, I don't see market timing as a dirty word, which many fund managers seem to think of. But where do you start seeing the difference between market timing and good risk management, which is something I think one should do, and the sort of cash kind of allocation strategy? Because you said earlier on that it's not market timing, but risk management is about market timing.
Well, Roland, we would say that risk management and generating returns actually go hand in hand. The key to long-term wealth creation is to minimize the risk of permanent capital loss. So that is the crux of it, is that if you are minimizing your permanent capital loss, if you're minimizing the losses in your portfolio, you actually over time are in a much better position to generate the best real returns over time. But it really comes down to that definition of risk. We don't think risk is volatility. We don't think risk is your position relative to an index. We think risk is about the absolute risk that you take having any stock in your portfolio and the risk of loss in terms of permanent capital loss. Now, people have often asked us, well, as value investors, you buy something that's cheap and sometimes it gets cheaper. You know, is that not capital loss? Well, no, that's temporary loss. Yes, it is. But the key difference between that and buying expensive equities, which you're hoping will get even more expensive, is that if you buy the expensive equities, you have absolutely no fundamental guarantee that that will continue. And you have no guarantee that once it falls, it'll ever get back to those levels. Whereas if you're buying something that is cheap, substantially cheap relative to what it's actually worth, and it gets cheaper because there's bad news, that's a temporary loss of capital. You know that that equity is worth substantially more, and at some stage, may take a while, but at some stage that value will be realized. So risk and return generation, they really go hand in hand.
Yeah, I mean, and I think both Roland and Linda's have kind of spoken about the natural protection of being in a value-based strategy rather than being in a very go-go momentum type strategy where you're trying to you're looking for more and more earnings just to drive the share price higher and higher. And hence the irrational behavior often with go-go stocks and with anything that's momentum driven is just so much more than it is of the value cycle, because the value cycle is literally being sold for death. Linda has done some more research that we'd like to share with you. She, as a matter of fact, has a look at 3 different strategies. The one is obviously owning just equities. The other one is making use of some derivatives, and she'll take us a little bit into what she means by that. And the third strategy is by actually owning cash. If you look at your screen right now, you'll see the test period that was actually utilized for the 3 different strategies. You're looking at the S&P 500 through time there, and you just look at it since 2005, you see the run-up. And I mean, it's a fairly decent period in order to actually test 3 different strategies, because we've seen both kind of bull markets and bear markets in each one of those strategies, and then obviously the flat line in between, you know, and the market literally goes nowhere over the time period. Let me just show you the 3 different outcomes for that, for the 3 different strategies. If you owned only equities, which is the first one over there, you can see the return that you would have gained at about 3.4% per annum. You see the risk, that's a standard deviation, 24.3%, and the maximum drawdown at minus 55%. Once you start adding some derivatives, that's the 10% tail risk protection that Linda was talking about. You see the return at 1.6% and the risk at 19.6%, and then total drawdown at minus 48%. But once you add cash, and you can see she's adding 25% cash and 75% S&P 500, you can see the return there, 3.2%. 16.9 for risk versus a maximum drawdown of minus 42%. So certainly there is value in holding cash. Linda, maybe just a question for you. Just maybe explain a little bit around kind of the maths that you use for that tail risk protection.
Sure. So essentially what this is an equity portfolio which is using short-term volatility futures, VIX futures, to essentially gauge volatility in the market. So as markets decline, typically volatility spikes, and you would make some money on those futures, which should offset some of the downside on your equities. So there, you know, you put 10% of that kind of strategy, those short-term volatility futures. But with any derivatives, like any buy now, pay later scheme, there's a financing rate attached to it. So you've got to account for that. There's a cost, there's a fee. And so it's similar to a short-term cash rate, which is why we've included that negative 10% cash rate. And the very crucial thing about these results is that, sure, having that tail risk protection strategy did decrease risk if you measure it in terms of standard deviation, and it did make a marginal improvement in terms of the drawdown, but it substantially reduced your returns as well. Yeah. And that's the problem with a derivative protection strategy, is that people often don't think about the costs associated with that. So there are costs, and unfortunately, you know, like any insurance, if you want to buy insurance in a very expensive, crime-ridden neighborhood versus a very safe neighborhood, it's going to cost a lot more in the crime-ridden neighborhood. So when volatility is high, when there's a lot of uncertainty, this kind of insurance costs more than it does when there isn't that uncertainty.
I mean, Linda,
and then the cash position is really just assuming that it remains constant and not taking into account the fact that you would be building more cash prior to the collapse and decreasing that cash to employ back into the market. So this is actually a conservative estimate of the benefit of cash versus the derivative strategy.
Roland, when we're talking about derivatives here, she talks about the cost of derivatives. Another issue is often staying in the market using derivatives when you should perhaps be reducing your exposure to the market during a downturn. And then, of course, how do you exactly price that risk in the future by taking out the derivative? And what is the right hedge that you should be using?
Well, I mean, derivatives are an explicit sleep better strategy. I like the fact that Linda compares them to a crime-ridden neighborhood, but derivatives are expensive, but it's like your car. You pay it and you are protected. Cash has also got a cost attached to it. We mustn't forget that getting into cash and getting back in the market takes time, which is a cost, and also transaction costs can be quite big depending on how illiquid the shares are that you're getting in and out of. So there are opportunity costs with cash. In fact, that's the biggest cost with cash is if you're too long in cash, you're going to miss the boat, and that can also cost you, whereas with derivatives, you don't necessarily have that kind of problem.
Linda, just a closing comment from you with regards to the opportunity cost of holding cash and then moving back into equities when the time is right. How does value investing ensure you get that right kind of exposure?
Well, Roland is correct, especially with yields being so low. Obviously, there is an opportunity cost attached to holding cash. But the way that we look at it is if you want to remain fully invested throughout the market cycle, you're buying expensive equities for the sake of being in the market, you are guaranteeing yourself poor long-term returns. However, having cash in the short term means that yes, in the short term there's an opportunity cost, but you're at least giving yourself the possibility of earning good long-term returns. And really, it's about that comparison. If you buy in at expensive levels in the market and you remain in the market at all points in time, there is a cost in terms of your prospective returns. Cash gives you that dry powder to really invest in the market when risks are lower and stocks are trading at absolute value, way below what they're worth.